Hello and welcome to episode 490 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
Well, I'm good, Andy, but slightly concerned. It's been a bit of a worrying week for everybody at Money to the Masses, hasn't it? Because Lola, we haven't mentioned Lola for some time, who is she's really a mascot of Money to the Masses. I don't see her as often these days with people working from home more often. But Lola's been a little bit in the wars, hasn't she, Andy?
Yeah, so Lola's our pet miniature schnauzer who, during the lockdown period, she kept us all busy and happy going out in the fields and going for lovely walks. And then obviously once things started to return to normal, Lola came into the Money to the Masses tower and became, like you say, a bit of a company mascot, and she's been with us ever since. So she had a routine operation, but the vet called me to one side when I came to pick her up and said, look, there were a few complications. And I won't go into it because it is quite distressing. But the good news is she's okay, but she's just going to take a little while longer to recover. She's got a big scar and she's feeling a little bit sorry for herself. She's wearing the cone of shame at the moment to stop her from getting at that wound. But yeah, she will be okay.
Yeah, bless her, because we've seen her on our catch-ups and like you say, she's got the cone of shame, and knowing Lola, she loves to wander around sniffing. That must be driving her insane. But the good news is, as you say, Andy, her spirits have picked up and she's on the mend. So moving on, then what's on this week's show? We've got quite a lot packed in as usual. So the three pieces we're going to be covering is bond markets. So bond markets have hit the headlines in recent days, and it's even made the news and the national news, consumer news, which is very unusual. And I'm going to be explaining what's going on with bond markets and why everybody's suddenly worried about rising bond yields. So what does it mean for you? And the second piece is in relation to pensions. I'm going to be inspiring people. We've covered pensions recently, but I want to tell people that even if you've got no pension fund at all, whether you're 30, 40 or 50, how you could build a pension pot and how you could retire just by putting £100 a month away. Now, the final piece, Andy, you're going to be covering is in relation to tax returns.
Yeah, so I'm going to cover a quick checklist of exactly who should be completing a tax return, because it is a little bit confusing. Obviously, people's situations change. And so I'm going to be going through all the different types of situations where you might need to submit a tax form, kind of a checklist for people who are new to doing a self-assessment.
And we're doing it this week because you will have enough time to submit that tax return before the 31st of January deadline. Now, moving on to the first piece, Andy, and bond yields. So to understand what's happening, let's get back to the basics. So what is a bond? Now, a bond is essentially an IOU. So when governments or companies need to borrow money from investors, they issue a bond. Now, in return for that lump sum of money, which they call the principal that they are borrowing from the lender, they will promise in return to pay a regular interest payment. So these are called coupons, and these are usually fixed. They can go up in line with inflation, but they're usually fixed, and hence the name fixed interest, which you often see associated with bonds. Now, you can buy and sell these loans to other people at any time, and this is essentially what the bond market is. And in a low interest rate world, or one where rates are falling, an existing bond paying a higher level of interest is obviously more attractive. So there is an increased demand for it, and therefore investors are willing to pay a bit more for that bond and that stream of income that comes from it. And so the price goes up. And conversely, in a world where interest rates are rising, bonds can become less attractive, and so their price falls. So if you think about it, in a world where the Bank of England starts to increase interest rates because of inflation, then you can see why bonds become unattractive in a world of high inflation. Now, one of the really important bits is that bond prices and yields move in opposite directions. So when bond prices fall, the yields, so that's obviously the return investors earn from the bond, start to rise, and vice versa. And that happens because the yield is calculated based on the bond's fixed interest payments relative to the current price. So if the price of a bond drops, but the interest payments stay the same, the effective yield increases. So right now, bond prices have been tumbling and yields are spiking to levels we haven't seen in decades. So why is this important? Well, firstly, it will surprise most people listening to this that the global bond market is larger than the global stock market. So the bond market matters, even if you don't know about it or hear about it. Also, for investors, traditionally bonds have been seen as a haven asset. So they offer stability and somewhat predictable returns. So the bond market is usually a fairly boring thing and doesn't make headlines in the mainstream press. So one way to think about it is to use an analogy of a skyscraper, and think of the bond market being the foundations, and each floor you move up that skyscraper, that represents another investment market or asset type. And the further up the tower you go, the more volatile the asset price or investment market is. Therefore, the top of the building is reserved for the exciting and sexy stuff. So in the real world, that's things like restaurants and viewing points. But in my analogy, it's the stock market, and the very top is things like probably emerging market equities. Now, ordinary people aren't interested in the foundations of a building. It's only engineers and architects that look at that kind of thing. Everyone else is sort of looking at the top. And it's the same with financial markets and consumer journalists. So everyone is interested in the stock market, which is why it regularly hits the headlines. But the bond market doesn't gain any interest at all. But the bond market is important because when it wobbles and cracks start to appear, it can cause the whole building to start to shake. And in my analogy, obviously, cracks in foundations means that you'll start to see wobbles in the stock market. And for people who are not into investing, rising bond yields also matter because of borrowing costs. So if bond yields go up, they influence the borrowing costs for governments, businesses, and individuals. So for you and I, it might start to show its face in mortgage rates, or we might start to see loan rates go up as bond yields start to go up, and that starts to impact our household budgets. The other thing you start to see is things like pension funds start to hit the headlines because they invest heavily in bonds because they want to meet the long-term retirement income needs. That starts to therefore potentially impact millions of people. And if you go back to, do you remember the Liz Truss debacle? There was a period of time after her mini budget where there was lots of concern about pension funds. Now let's give some context to the recent bond market wobble that we've seen. So a loan to the UK government is called a gilt, and if you look at a 10-year loan, so the 10-year UK gilt, the yield on that has risen to levels we've not seen since the financial crisis back in 2007 and 2008. And the yield on the 30-year gilt has reached levels we've not seen since 1998. But it's not just a UK thing. If you look around the world, the US Treasury yield, so Treasuries are the equivalent of the gilt in the UK, so Treasuries are loans to the US government, they've started to rise, and the 10-year US Treasury yield is back at levels we've not seen since the financial crisis as well. So what's causing this sell-off in bond markets? So when we see the sell-off in bonds, the yields are going up. Now, there's a number of reasons for it. So one of them being persistent inflation. So we may have had lots of rate hikes by the likes of the Bank of England and the Federal Reserve in America over the last few years, but inflation is still proving sticky. And of course, those central banks, European Central Bank included, have started to cut interest rates, but they've held off a bit. They've not done it as aggressively as people perhaps thought they would do because inflation has been that much stickier than people had predicted it would be. We've also seen bond markets become a bit jittery because of the mixed signals we've got from central banks when they've done their announcements of their latest interest rates or press conferences. And so we've got to a stage now where if you look at the swap rates in the UK, which give an indication of where the market thinks the Bank of England base rate will be in the future, well, they have changed a lot in the last couple of months. So if you go back just a few months, the market was predicting that the Bank of England would cut the base rate aggressively in 2025. We'd probably get down towards, well, just below the 4% level. And over the next 5 years, we might move towards about 3.5% as a long-term rate. Now, the market has repriced where it thinks the Bank of England base rate will be in the coming years. And it's been a significant repricing. So now the market doesn't think the base rate will get below 4% at any point over the next 5 years. And during 2025, we might only see the Bank of England take about 0.5% off of the current base rate, which, as I make this particular show, is at 4.75%. And if we get uncertainty about interest rates, it leads to volatility in bond markets. We've also got to add in the global economic uncertainty out there, so geopolitical risks. We've even got the threat of trade tariffs from Donald Trump. That all adds to the uncertainty because investors, when they are uncertain, start to demand higher yields to compensate for the risk of potential government defaults and the possible return of inflation, which we could have because of those trade tariffs. Now, in the UK, we have our own set of problems as well, which add to things. So we had the recent autumn budget from Rachel Reeves, and this has really concerned markets due to the size of spending plans, as well as the tax hikes. Now, I'm particularly talking about the employer national insurance hikes, and a number of companies have come out and said they're going to have to pass those on to consumers. Well, that will be potentially inflationary, so we could see inflation pushed up or just be a little bit more sticky. Now, that starts to limit the ability of the Bank of England to cut interest rates. So the bond market hasn't liked this, and it's seen yields go up on the cost of government borrowing. So that's why we're seeing gilt yields go up. And this has increased the chance that the Chancellor will breach her own fiscal rules, which she set in place. Now, there were things called the Stability Rule. All you need to know is that they were trying to make sure that day-to-day government spending was balanced by revenue. So it's going to prevent borrowing for routine expenditure. The rise in gilt yield starts to put that headroom that was there under pressure. I suppose if I was going to use an analogy, it's a bit like if you had your own finances and you had your own income coming in and you had your own expenditure and your own debt you're servicing. If the interest rates on those were going up, it would mean you're going to struggle to make ends meet and actually meet your plan. Well, that's kind of what the government is potentially going to see if yields keep rising. So that got everybody a bit spooked, and we started to see yields keep going up. And we also saw the pound fall to a 14-month low against the US dollar. It was a bit of a vote of no confidence. So you started to see parallels being drawn with what happened after Liz Truss's famous, or I should say infamous, mini budget back in 2022, where effectively rising bond yields actually saw her have to quit her job as Prime Minister. Now, we're not in that scenario at the moment. So despite what people think and the headlines suggest, the rises we've seen aren't as significant as that. So I just want to get a bit of context and a bit of realism to what's been going on. But it doesn't mean that we're not going to feel something if things carry on for a while. So we've seen in the last 24 hours a little bit of a respite from rising bond yields. But for people out there, they may already started to feel the impact or could do in the future. So if you're an investor, you will have noticed the value of your bond fund starting to fall. Now, going forward, there could potentially be an impact on stock markets as well, because if it gets to a point where the yield keeps rising, and if you've listened to my market update show, I mentioned on there's been some analysis to suggest once the 10-year US Treasury yield gets above 5%, it could make Treasury so attractive that people leave equities and start to buy bonds. And if that happens, you could see a correction in stock markets. So the bond market instability could lead to instability in stock markets. But for the rest of the world who aren't necessarily engrossed in investing, rising bond yields could impact things like mortgage rates, as I've already mentioned. But to give some context to that, where we are at the moment with mortgage rates, if you look at the best 2-year fixed rate mortgage deal out there, it's roughly around where it was 2 years ago. So there's a whole load of people who are now thinking about remortgaging again after the period of time when Liz Truss sent bond yields soaring. They came down a bit. We saw mortgage rates do the same back in 2022 into 2023. They may have been hoping that mortgage rates would be lower now when they come to remortgage. Well, this latest wobble in bond markets has seen mortgage rates creep back up again. It's too early to say whether that trend's going to become entrenched, but just to give people an idea, that's where we are. So make sure you keep an eye on where mortgage rates are. We do have tables we update a couple of times a week, which we'll put links to in the notes of this particular show and video, so you can keep up to date what's going on in the mortgage market. With pensions, you're going to probably see things like pension funds may be impacted if this continues into the future. But at the moment, it's very early days. One thing that is a positive, of course, of rising bond yields is that you get better annuity rates. So that's something that we saw back after the 2022 rise in bond yields. We saw annuity rates go up, which is good news for people who are retiring. So at the moment, I would say that the wobble we've seen is nothing more than that. And actually, if you look at the 10-year US Treasury yield and you zoom right out, we've seen an uptrend generally in bond yields, which is counter to a very long downtrend in bond yields around the world. And that was because we obviously saw quantitative easing after the financial crisis. But since the pandemic and the world opened up again, we've seen lots of inflationary pressures and bond yields have really been going up. So if you look at that 10-year US Treasury yield chart, you would see that we have had that going up over the last couple of years. It started to come down again, but then this latest wobble just kind of continued on that overriding trend of seeing bond yields creep back up, or I should say Treasury yields. So at the moment, what we've seen in the last week or so is something of note, but not particularly anything to become too concerned about. We see these kind of wobbles periodically, so don't panic. And if you're an investor, it's just another emphasis or reminder to remain diversified and review your portfolios. And if you are worried about mortgage rates, do make sure that you seek advice from a mortgage advisor.
Yeah, and we'll put links in the show notes to an article where people can find an advisor if they haven't already got one. Right, so Damien, moving on to the next piece then, we're talking pensions. Covered pensions on the podcast a few weeks ago. They're very popular, actually. So you've been digging into the numbers, and this piece is really about how anyone can get a pension and retire from just paying in £100 a month.
So I'm going to inspire people who maybe have no pension fund at all. They may be 30, they may be 40, they may be 50, who are worried about their retirement. And I'm going to explain how they are going to be able to retire with just putting away £100 a month. Now, of course, the more you put in your pension, the better. But when we've done recent videos about how much you should have in your pension at given ages, there's been lots of comments from people who have said things like gloating, really, about how much they have, and people obviously panicking. And what I want to do is those people who are worried, I want to point out there are decisions they can make that can make a huge difference about the kind of retirement they're going to have. So what I've done is I've played around with some calculators. There's a whole range of pension calculators out there, and I'm going to show you how you can do it. I'll put links to 2 of them in the notes of this particular show, and you can go recreate what I've been talking about or use examples that are personal to you. Now, in the examples I'm going to be doing, I'm going to be talking about somebody who's 30, somebody who's 40, and somebody who's 50 that has no money in their pension and they're about to start. I'm going to use a couple of assumptions as well. So first of all, the maximum tax-free cash you can take from a pension, as we know, is £268,275. I'm going to assume that you are going to be paying 1.5% in terms of charges on any pension that you have. So we're talking about defined contributions here. I'm going to assume as well a growth rate of 5%, which is in line with the medium risk level that the FCA stipulate. I'm also going to assume inflation at 2%. Again, this is in line with the recommendations of the FCA, and that enables me to bring all of the numbers I'm going to talk about into today's numbers. So by that, I'm taking into account inflation. So just think about when your nan tells you about her house, which is probably worth 400 grand today, and she bought it for 10 grand back when she was younger. It's to bring the numbers into today's value. So there's no point talking about a pension of £30,000 if it's £30,000 in 30 years, because you won't be able to buy anything with it. The numbers I'm going to be quoting are the £30,000 in today's numbers. When we project it into the future, it'll actually be a lot bigger than that. But it's to give you context so you can understand what retirement would look like if it happened today. Now, I'm going to also assume contribution increases at a rate of inflation of 3%. Again, that's standard. And we're going to assume annuity rates that are based upon a single life and annuity rates as they are today. So that's how you can work out the rough income you can get from a certain pension pot. I'm also going to assume a retirement age of 68, because most people listening to this video will have a state retirement age of 68. So that's when you get your state pension. And I'll assume you'll get your defined contribution pension then. You'll access it then. You'll wait until that point. And as I've mentioned already, I'm going to assume you've got no pension fund. The other thing I'm going to assume is that you're getting a salary which is the median in the UK right now, according to the Office of National Statistics, and that number is 37,500. So that's the median, slightly different to the average, but it's broadly the same thing. Now, the first example I'm going to do is someone aged 30, and I'm going to assume they've got no pension pot at all, and they're not going to get a state pension. I'm going to assume the government's going to scrap it before you get there. Now, I'm also assuming that you're going to have a salary of 37,500, and you're going to want to generate that from your retirement pot. So how much would you have to put in today's money so it would actually work out to be the equivalent of 37,500 when you got to age 68? Now, actually, you'd have to put in £1,050 a month, which is a third of your salary, to build a pot big enough to generate an equivalent of 37,500 a year. Now, first thing I'm going to say is you are only going to need to generate about 2/3 of the 37,500 what you're earning now when you get to retirement, because you will unlikely have a mortgage. So that means that your pension pot only has to generate £25,000 a year. So to do that, you would, as somebody who's aged 30, have to start putting in £750 a month, which roughly equals 24% of your salary. That's still a very big number. Don't worry. The next thing I'm going to say to you is I'm going to assume that you're not going to take any tax-free cash when you get to your retirement age. You're going to have actually paid off your mortgage. You're going to make sure you don't need to rely on your tax-free cash. So everybody is generally entitled to 25% of their pension pot they can take tax-free. You're going to use all of your pension pot to generate an income. That means if you do that, then the amount you need to be putting in a month today is £575 a month, which is 18% of your salary. Now, as I mentioned, that amount is going to go up each year by inflation, but so is your wage. So you don't have to worry about that when I'm using these examples. Now, the next thing you're going to do is you're going to ensure your pension isn't overcharging you. So you're going to make sure your pension total charges is not going to be 1.5%, but you're going to drop it to 0.5%. Now, this is roughly what Nest charges. So that is the scheme that most people will probably be in if they are employed. Now, if you do that, or if you've got a pension with anyone else, you go and make sure you're in low-cost funds and you're not overpaying on platform charges, then you can drop the monthly contributions to £475 a month. And in doing so, you will still hit that £25,000 a year income that you're going to have to generate from your pension pot. So it means your pension pot is going to be bigger because you're actually paying less to the pension providers. Now, you are young. I'm going to say you've probably got the ability to take more risk. You're not going to be able to access your pension pot for 38 years. You're only 30. I'm assuming you're going to take it when you hit state retirement age at 68. So rather than invest in a default fund or a fund that's only going to potentially give you a return of 5%, try and take a bit more risk. I'm not saying this is for everybody. It's down to your personal risk profile. But if you took a bit more risk, and let's say you got 8% a year, which is one of the levels that the FCA do allow to be used in projections, then that brings down the amount a month you need to put into £160 a month. So don't languish in default funds, and you could take a bit more risk. It will mean your fund will grow more quickly through the power of compounding, and so you have to put in less. Now, the next thing is make sure if you are employed that you auto-enroll. There is free money on the table here. So if you pay 5% of your qualifying earnings into your pension, your employer has to pay 3%. Now, qualifying earnings are between £6,240 a year and £50,270 a year. So there are certain rules about who qualifies for auto-enrolment. Put a link in the notes of the video so you can read that in more detail. But if you did all of those things that I've said and you auto-enrolled, it does actually mean that you could only have to pay £130.25 into the pension each month, and your employer will pay £78.15, and you will achieve that £25,000 a year that you're trying to get as a retirement income when you get to age 68. But of course, those numbers I've been talking about are gross numbers. So if you claim tax relief as a basic rate taxpayer, that is actually only costing you £104.20 in reality. And of course, in my example, you're a basic rate taxpayer, but people must remember if you're a higher rate taxpayer, you can claim, for example, 40% tax relief. Now, the rules, just to reiterate or remind people, to achieve what I've said, you should make sure that you auto-enroll. You need to check the pension benefits that you get if you are going for a new job, for example, and make sure that they are as good as they can be. You need to check your scheme charges. You want to talk to your employer if they are expensive and say, hey, can't we do something about that, and drive them down? And don't invest in default funds. Make sure you engage with your pension, and also don't rely on taking your tax-free cash when you get to retirement. So you need to make sure, which most people will be on these days, make sure you're on a repayment mortgage. Now, what about the 40-year-old that has no pension pot, is starting to pay in? wants the equivalent of 37,500 retirement income at the point that they get to their state retirement age at age 68. Now, if they want to do that, they're going to have to put in £1,620 a month, assuming they've not done any of the things I've explained that the 30-year-old was going to do. Right, that is a big number. But if instead they did all the things that I told the 30-year-old to do, and they are paying £130.25, that's gross a month, that's 5% employee contributions, and they're getting the employer contributions of £78.15, they would be a shortfall on the amount of income that they need. But I'd argue they're probably going to get their state pension. So if we do add the state pension into this particular example, and at the moment it's £11,976, and as I've said, I'm working back into today's numbers. If you combine that with the income they would generate from the fund they're going to grow from their contributions that they're now putting in, they would end up with an annual income of £28,376 a year generated from the age of 68. Now, of course, the income is taxable, so they have to bear that in mind. But you can see they have got to the stage where they are generating an income that they desire. Now, what about this person who's age 50? Now, technically, their state retirement age is likely to be 67, but I'm going to use 68 because it just makes it nice and easy. They've got no pension. Then, if they do all of the things that I've suggested, but not the boost in the growth rate from 5% to 8%, because they've probably got less time to be able to take the risk. So I'm going to leave that as it is. Then they obviously aren't going to be generating anywhere near the type of pension that they need if they're only getting those contributions from their employer of £78.15 a month, and they're only putting in a gross amount of £130 a month. What would happen is they'd end up generating from their pension pot at age 68 £3,910. But if you went to your employer and said, look, I know you only pay my contributions on the qualifying earnings, can you do it on all my earnings? Because they could. If they did that, and you, for example, paid your 5%, then that starts to boost the numbers up. And if you also ask them, for example, to say, can you match my pension contributions? That boosts the numbers even further. And everybody, not just the 50-year-old, should go and ask their employers to match their pension contributions, because that is free money if they want to do it. You could forego a pay rise 1 year and say, can I have the pension contributions boosted? And if you do that, the amount of income that can be generated from your pension at age 68 is just under £5,000 a year. Now, let's assume that your partner, if you're married, does the same thing. That's £10,000 income you've now got from age 68. And if you add in the state pension of nearly £12,000 each, assuming you're both going to get it, then we're looking at something like £34,000 a year income that can be generated. Yes, you're going to be relying on getting the state pension, but suddenly the world looks a lot better because of the decisions that you've made now. So just because you haven't got a pension pot, that doesn't mean don't start. It means you just need to engage with it. But also, because you are going to rely on your state pension, you need to check your national insurance record, make sure there's no gaps. Now, I'm not giving you obviously a solution to be able to retire and have the best retirement, but I'm giving you some hope. So if you do all the things that I've mentioned, then hopefully people are going to feel a little bit better about life, but they're also going to engage with their pension and start on that journey if they haven't already, rather than bury their head in the sand.
Okay, so let's move on to the final piece of the podcast then. And January the 31st is fast approaching, which is the deadline, of course, for submitting your online tax returns for the tax year 2023-2024. Now, just to clarify, that tax year started on the 6th of April 2023 and ended on the 5th of April 2024.
And I love the fact that you're being cut up there, Andy, by Lola in the background, who's obviously feeling a lot better, because I don't know if people listening can hear. She's sort of sneezing and shaking and all sorts of things, and she's obviously feeling better. So, yeah, we would normally cut it out, but we're going to include it this week just because it's nice to see that Lola's actually feeling better.
Yeah, she's just come right by my feet here to keep me company for this last piece of the podcast. She heard me talking and thought, what's he talking about over there, talking to himself?
It's tax. She'll go back in her bed in a minute. She'll be bored senseless.
So we thought this would be a really useful piece of the podcast. We're going to keep it all in, Damien. We thought this would be a really useful piece of the podcast because we're going to provide a really quick checklist of all the situations in which you might be required to submit a tax return. Because as I said earlier in the pod, situations change all the time. In fact, my situation in my own family has changed. My wife has changed jobs. And so you've got to think about these things. So as a general rule, if all of your income is taxed under the pay-as-you-earn system and you have no chargeable gains and you're not liable for any other certain tax charges, such as the high income child benefit charge, then you shouldn't need to notify HMRC of any liability, but always check with an accountant if you're not sure. So the first thing I would recommend people do is check out the HMRC tool. I'll put a link to it in the show notes. Essentially what it does is it will guide you through a series of questions, and by the end of it, it will let you know whether or not you should be submitting a self-assessment tax return. I've gone through that form and I've looked at all the different scenarios in which people might need to submit a tax return. And I'm going to go through it now in this piece. It's kind of a checklist we'll run through. So first of all, if you are self-employed and have income before expenses that takes you over that £1,000 trading allowance, we talked about that last week. So if you are that person, then you'll need to be doing a self-assessment tax return each year. If you are a partner in a business, then you'll be required to do one as well. If you have property income that exceeds certain allowable limits. Now, I'll explain what those limits are. If you have gross rental income coming in less than £1,000, then there's no need to complete a self-assessment tax return, as the rental income is exempt under the property allowance rules. As we go up, though, if you're accepting more income in terms of rent, then you might be, and I'll explain different scenarios. So if you have more than £1,000 in rental income, but less than £10,000, and this is a crucial bit, and you have net rental profit of less than £2,500, you should be contacting the HMRC to let them know about the income, and HMRC then may be able to collect the tax on the rental profit via adjustment to your PAYE tax code if you have one, or by simple assessment. If you have more than £10,000 rental income or more than £2,500 net profit, then you should complete a full tax return by self-assessment. Moving on to the next few scenarios, if you want to claim tax relief on employment expenses that equates to more than £2,500 in a tax year, then you need to be submitting a return. If you have capital gains tax to pay, which wasn't already paid, what they call in year, so there's leftover capital gains to pay, then you'll need to do a return. Interesting one here, if you're a minister of religion of any faith or denomination, my guess is if you are one, then you probably already know that, but it's interesting to know. If you receive foreign income, then it's likely you'll need to do a tax return. There is a bit of a nuance in there, because if that foreign income is part of a dividend, then it might fall under the dividend allowance rules, but always double check with an accountant if you're getting any foreign income, because you may need to do a return. If you're going to need to claim tax relief under a double tax agreement, then you'll need to be submitting a return for that. If you're a non-UK resident and have taxable income in the UK, that's another reason to be doing a tax return. If you have income from UK savings and investments of £10,000 or more, excluding anything held in an ISA, of course, then you'll be needing to do a self-assessment return for that. And if you have income from UK dividends of £10,000 or more, the same applies. And moving on to the final few scenarios then, if you have untaxed income of £2,500 or more, you'll need to be doing a self-assessment for that. And if you need to pay the high income child benefit charge, again, you do that through self-assessment. And finally, just to mention, there's been a change to the employment income threshold for the tax year 23-24. Prior to that tax year, if you had taxable income of £100,000 or more before tax, then you would need to submit a self-assessment regardless. That has actually been moved up to £150,000 for the 23-24 tax year. And actually from next tax year, there is no threshold for that. So there isn't an automatic requirement for people to do a tax return based on income. HMRC have said that they've sent letters out to people that are affected by that change. So if there are people out there that have submitted a tax return in a 2022-23 tax year, and if they earn between £100,000 to £150,000, and they purely earn their income through PAYE, and they've not met any other criteria for self-assessment, then they've been told ultimately that they don't need to submit a tax return this year. And just a reminder, from next year, there is no threshold at all. So if you're one of those people that's having to do it because you're just a high earner, then that's good news for you. It's less admin. And just a few final things to cover off. You do need to make sure that you do your tax return by midnight on the 31st of January 2025. That is also when the tax is due. Depending on how much you owe, you may be given a second payment deadline of the end of July, 31st of July 2025. That's for making advance payments towards your tax bill. It's referred to as a payment on account. It will really depend on how much tax you owe as to whether that will be something you need to do. If you can't pay your tax bill in full by the deadline, you may be able to speak to the tax office in regards to a payment plan or schedule with HMRC, so do speak to them about that. If you do file your tax returns late, you may be liable to a penalty. The penalties are £100 if you file up to 3 months late, and then you'll have to pay an additional £10 for each month you are late after that, up to a maximum of £900. You may also be charged interest on those late payments as well. And just finally, if you have received a penalty for a late tax charge and you feel that you've been unfairly treated, if you feel that's wrong, there is a way that you can appeal online. I will put a link to that in the show notes. And so there we go, Damien. I know tax can be boring, but I thought it might be quite interesting to bring that to the podcast. Bit of a checklist. I think the thing on the rental income is particularly interesting. And also that threshold, that high income threshold, that's changed for this year and it'll be scrapped next year. It was interesting. I didn't know that before I started to research this piece. So that is it, I think, Damien.
So that's a great piece to finish the show on, Andy. So do make sure that if you are impacted in any way that you register for self-assessment, and you also make sure you pay your tax on time. So that's it for this week. As ever, do make sure you follow us on all our social channels, Instagram, TikTok. Make sure you join our Facebook group, facebook.com/groups/money to the masses. We're doing lots more on socials, and Andy's doing a lot of work with chopping up bits of video and putting it out on social. So do make sure you follow us and like it and engage with it, because it does really help us. Also subscribe to the YouTube channel, leave any comments that you've got there as well, because again, it's really good for engagement for the show. And please do leave a 5-star review wherever you do actually listen to the podcast. I know a lot more people do listen to the show on Spotify these days, but if you are on an app like Apple Podcast, then do leave a 5-star review and we'll read that out and you could win a Money to the Masses mug. But if you are using something like Spotify, then email in and we can still read out your review. So that is it, Andy. That's all for this week, and all that's left for me to say is until next time.
Until next time.